Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is accounting for equity investments, lack of significant influence. So, what do we have here? Sorry, reporting categories for investments. We have three categories based on the US GAAP, and also IFRS, not that different. Equity investment, the investor does not have significant influence. That is our video today. Over the operating and financial policies of the investee, typically owns less than 20% of voting stocks. We also have significant influence between 20 and 50% of the voting stocks. Then we have the equity method. And we have a video about equity method, and the video is in our video description. And when we control the investee, when we own more than 50% of voting stock, or when we have the full control. And we have the consolidation. And consolidation is a very large topic. We will have it probably on 2021. So how do we work with the when we don't have significant influence? When we own shares, when we own stocks. Uh, We work with fair value through net income, just like bonds when we have them for trading. Or similar for the trading, securities approach used for debit. Investment reported at fair value with unrealized holding gain and losses included in net income, unless fair value is not readily determinable. So, uh, usually when we purchase stocks that are not available on stock markets. Okay. So, how do we do that? Let's go to our Excel file. Here, our Excel file, and the Excel file is also in our video description because all our Excel files, they are free to download it, so you can do it anytime you want. So what do we have here? The following events during 2020 and 2021 pertains to Scarpin's investment in the common stock of Santiago Inc. So Scarpin, my fake company, is my last name, and Santiago is the last name of my wife. So let's do it. July 1st, 2020, purchased Santiago in common stock for $4.5 million, but it is less than 20% only purchasing stocks. What is our journal entry? Debit. Investment in equity securities, 4.5 million, and credit cash. So that is what we have. December 31st, we have dividends. So when we are talking about investment with lack of significant influence, dividends, they are revenue, just like any other revenue by cash. Debit cash, 75, credit dividend revenue, because it is a cash dividend. And now let's go to our fair value. Record a fair value adjustment to recognize a decline in the value of Santiago stock investment to $4.4 million. And here, it is not impairment. So it doesn't matter if our fair value is greater or lower than our original value. We recognize the gain or loss. Here, we purchase for 4.5. Now it values only 4.4. So we have a loss. How much is the loss? The difference between both. However, we don't credit investment. We keep this account here. We don't change it because this is our historical cost. We credit a contra account of the investment. That is fair value adjustment. And if we have gains later, we debit the same account. So this fair value adjustment here is for gain and losses. Let's change this number here, and then we can have some gain. So Instead of 4.3, let's 4,430. Okay, that is a live video, so we can do that. January 5th, 2021, sell the Santiago stocks for $4.430 million. What do we have here? Now we don't have a loss anymore. So what do we have here? We debit fair value adjustment because we have a gain on investment. And it is unrealized net income. And we have the difference now. We have the $30,000 here. So fair value adjustment is the difference 30 and then the gain. So here we have the adjustment fair value here. And then what do we have? We have, it is not gain, it is fair value. Now we are selling it. How much? Cash for 430. Investment 4.5. And we need to balance this journal entry here. Credit less debit. And this balance here will also close the fair value adjustment. So when we sell it, we have no gain and losses because we recognize the gain and losses in a separate journal entry. If we want to combine them, we can do that. So fair value would be 100 and then the gain $30,000. So we can also do that combining both journal entries. However, it is not the most accurate method or not the best method to be worked with. Okay, guys, so that's it. And we use these methods for any purchase of stocks that we have if we have lack of significant influence in the company. Okay, guys, so thank you so much. Subscribe our channel, like this video, like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.